The last time the US pursued tight monetary policies was here in 1979, 1980, at the time when debt to GDP was 140%, and at that time Mr. Paul Volcker pushed up the discount rate to over 20% in order to reduce inflation. Now, with the debt to GDP at 375%, in my opinion, it is out of the question that the Federal Reserve will ever again pursue tight monetary policies. They will at some point increase interest rates, or the market will force them higher. But you can have interest rates like in Zimbabwe a year ago at 1,000%, and if inflation is 1,000,000% per annum, it's still not tight monetary policies. So all I want to say is, as far as I'm concerned, I don't think that under Mr. Bernanke or future Fed chairmen in the US, there will be the opportunity to pursue tight monetary policies. They will have to print money for other reasons as well, which I shall explain in a second. So that's important to understand. The background here is we have excessive debt, and that this debt growth will have to continue, otherwise the whole economy totally implodes. Now, I have to explain the philosophy behind US monetary policies. Usually, the Federal Reserve has always cut interest rates when there was a problem, because the Federal Reserve in the United States claims that it cannot identify bubbles. In other words, if you have excess in the real estate market, or if you have excess in the stock market and so forth, the Federal Reserve claims they can't see that. What they base their monetary policy on is core inflation. In other words, they target inflation without energy and food prices, which is not the correct way to measure the cost of living increases, because as far as I know, most people use energy and food. So just to target core inflation is wrong. But basically, the Fed has always maintained we don't identify bubbles, but if a bubble bursts, then we can take extraordinary measures to support the market. We can print money. And Mr. Bernanke has said that they can drop dollar bills from helicopters if it's necessary to support asset markets and to stimulate the economy. Now, that they won't do, but electronically we can print money. That's not the problem. Or if I'm the Treasury in the United States, I can send each one of you a check of $1 million, and then, of course, spending will increase for a while, of course, with some side effects and unintended consequences. But basically, if you want to inflate, it is possible. And in my opinion, the US is inflating at the present time. Now, this Fed policy was, of course, possible at the time, and I have to explain this also in more details, when interest rates were coming down. I have to stress that interest rates, like commodity prices, they move in very long cycles called Kondratievs. In other words, during the rising wave of the Kondratiev, which lasts between 20 and 30 years, you have a rising tendency in interest rates, and during the falling wave of the Kondratiev, during which commodity prices go down, interest rates tend to follow. So basically, the last great Kondratiev began sometimes in the 1940s, when commodity prices bottomed out, and at the same time here interest rates bottomed out. Here it's on the 10 years Treasury bond in the United States. At that time, the bond yield in the 1940s was below 2%. And then it was below 2% in 1949. Then it was at 4% in 1960, 6% in 1970, and then from 1970 on to the peak here on September 21st, 1981, interest rates went on the 10 years from roughly 6% to 15.84%. That was the peak. And after that, you can see that we've been in a falling interest rate structure until recently. Now, the big debate is, will interest rates go down further or not? My view has been, and still is, that we saw a major low in interest rates on December 18th, 2008. In other words, more than 9 months ago, when the 10 years touched 2.08% yield and the 30 years touched 2.53% yield. And then between December 2008 and March 2009, the economy in the world continued to weaken, but interest rates didn't go down anymore, which suggests to me that probably the way we saw a secular peak in interest rates here in September 1981, we saw a major low in interest rates here in December 2008, and that from here onwards you will have basically a rising interest rate structure. And this is important to understand in the context of investments going forward, because during this period of time of falling interest rates, bonds were a good investment. If you bought a 30-year US Treasury in 1981, you actually had a higher return than by owning US equities, stocks. But if interest rates go up, then obviously you don't want to own bonds and you don't want to own any fixed interest securities in the long run. As interest rates go up, bond prices obviously go down. And I'm mentioning this also because even if we have a gold standard in this room, we can still have a bubble somewhere. Under a gold standard like in the 19th century, if someone made a major investment or invention here in this corner of the room, say he discovered a gold mine or an oil deposit, or made an invention such as the railroad or a canal construction or whatever it is, then money would flow from the back of this room into this corner of the room, and obviously there would be inflation and prices would go up and there would be an economic boom and there would be a stock market boom over there. But at the same time, at the back of the room where the money would flow out to, into this corner of the room, at the back there would be deflation. So that's important to understand that under any condition we can have booms and busts. And that was the history of the 19th century. We had so many railroad booms and canal booms and real estate booms and so forth. But we didn't have a boom in everything. And the same happened in the last 50 years. In the 70s, we had an increase in commodity prices. The gold price went from $35 an ounce to $850 an ounce. And silver went from $2 to $50 an ounce, and oil from $3 a barrel to close to $50 a barrel. But the point is, it occurred at the time when when the bond market here was going down. Obviously, when interest rates go up, bonds collapse. So in the 70s, you have commodities going up and bonds collapsing. Or 88, 89, we had a bubble in Japan and in Taiwan in the stock market and property market. But we didn't have a bubble in commodities. But what Mr. Greenspan and Mr. Bernanke have managed to do is actually to create a bubble in everything. If you look at 2002 to 2008, everything went up. In other words, commodities went up. Equities in developed markets and in emerging markets, real estate globally went up, and even bond prices went up. As I said, this is unusual, and art prices went up, and worthless collectibles went up, everything went up. And then there was only one asset class that went down. From here to here, everything goes up, but one asset class goes down, that's the US dollar. And then here, 2008, everything goes down, but one asset class goes up, is the US dollar. And then since March of this year, there is a rebound in asset markets, in commodities, equities, and so forth. But what happens? The dollar goes down. And I want you to remember this relationship, this is very important. A weak dollar is a symptom that there is plenty of liquidity, that there is excess liquidity flowing into the world, and then it stimulates essentially asset markets to go up. whereas a strong dollar is a symptom of tight